Mr. YH Malegam is the country's finest chartered accountant and foremost financial expert. He is the go-to man when regulators have to make rules for complex financial situations. He has been member of the Reserve Bank Board for 21 years. He headed the SEBI Committee on Mutual Funds and on Corporate Governance, was independent director of the NSE, as also the Clearing Corporation. He is past president of the Institute of Chartered Accountants and has been director of over 24 companies in his long and distinguished career. Mr. Malegam can aptly be called the keeper of the country's financial conscience. Mr. Malegam, thank you very much for joining us. Well, let us start with the genesis of the bad loan problem. The banks repeatedly say that they are able to sanction loans, but they are not able to recover loans when they know it is going bad, because the legal system is in such a tangle. Over 2 crore cases pending, and they have to go through several rounds of the DRT before going to the courts. So is the legal system the biggest culprit?
I don't think so. It is, of course, a contributory factor. In my own view, if you look at bank loans which have got bad, I think it's because of inadequacy at 3 points. There is inadequacy at the point at which you sanction the loan. There is inadequacy at the point when you are monitoring the loan. And there is inadequacy when you take steps to make the recovery. Now, if you look at each of these 3 separately, unfortunately, there is a tendency in this country to lend money against security. But when you lend against security, it depends upon the nature of the security. For example, if you have lent money against inventory, which is going to be realized in the course of business, that inventory will generate cash. If you lend money against a factory or fixed assets, the only way in which it generates cash is out of the profits which it makes. Therefore, you have to have a different approach as to when you are lending against current assets, when you are lending against fixed assets. And I believe that too much attention is being paid to security and too little to 2 other factors which are important. The first factor, of course, is the quality of the borrower. I don't think banks are making adequate studies about the background of the borrower, his past record, his integrity, etc. But more importantly, they are not looking at the cash flows which will be generated by that asset. Now, as you know, if you lend against fixed assets, the only cash flows which are generated are out of the profits which are made, less the working capital which is involved. So, for example, as a rating agency, what we would look at normally is the debt servicing coverage ratio. So, this DSCR is an important matter. And so long as the DSCR is projected at a level of, say, between above unity and at, say, to 1.5, then you have adequate security.
The banks often tell us that even if the covenant triggers a recovery, assuming there was a covenant, they don't go for the recovery because the borrower goes to court and then they are stuck. So often they are allowing the loan to be, given more evergreened perhaps, because recovery is such a problem. You don't think so?
No, I would put it the other way, that if there was a covenant, the borrower in fact would be conscious of the fact that there is a covenant which may trigger a recall, and therefore he would be careful to see that the recovery is not triggered. So he would be more concerned with the observance of the covenant. The second problem which is being faced is that we bankers lend today partly as term loans, but also as cash credits and overdrafts. Now, when you lend as a cash credit or as an overdraft, In a sense, the bank is taking on the cash management of the borrower. If you were to lend more against a loan, the borrower would know what is the date on which he's got to make the repayment. He would therefore take adequate precautions to ensure that he has the liquidity available to make those repayments, and monitoring the loan becomes easier. Whereas when you have a cash credit facility, which is normally secured by hypothecation of assets and not by physical custody, very often the security disappears before even the bank is aware of what is happening.
Banks have been lending for 70 years, and there is a fair degree of sophistication, I would assume, in the last 2.5 decades, when most of them have become listed. And still rules like debt servicing capability and covenants to trigger recovery are not in the clauses?
There is, I think, another factor which I suspect is there. See, the concept today is that a bank wants to lend to a group. So, in a sense, in effect, it's lending to an entity in the group, but it thinks it's lending to the group. Now, in a group, there are different entities and owned by different composition of shareholders. So, there may be a common promoter, but the other shareholders, particularly for listed companies, there are outside shareholders. Now, if one company gets into difficulty, I think you cannot expect another company in the group to bail it out because the other outside shareholders are not involved. The position would be different. Let us see what happened when Tata Finance had a problem. Tata Sons put in the money because Tata Sons didn't have to rely upon outside shareholders. They were putting in their own money. And they put in the money to safeguard the reputation of the group. Now, the same thing doesn't happen in other groups. If the entities which are considered together are not entities which are wholly owned. And I think that is another factor, that too many bankers have been chasing too many groups to get a share of the pie, not realizing that legally these are separate entities and recovery would be very difficult.
Bankers' defense is that there is no penalty from the Vigilance Commissioner for inaction. There is a lot of penalty if you take a proactive stance and say, okay, for 100 rupees you give me 85 and we settle the loan. That is penalized. But if the 100 rupee asset rots for inaction and you get only 10 rupees or 1 rupee in the end or nothing at all, you're not pulled up, you're not visiting the CBI or the CVC.
I don't know about that, but I know that there is a committee called the Bank Fraud Advisory Committee. For 6 years, I used to be the member of that committee. And the objective of that committee was that when there was any action to be taken against senior management in a bank, let's say the chairman or the executive director or the general manager, even before a preliminary inquiry could be made, the CVC would refer that matter to this committee. And in the committee, we would look at that issue and say whether prima facie there is a case for an inquiry or not. So there again, we would look at it in the same fashion. We would say, on the basis of information which is available with the bank manager or the chairman, is there a right decision taken or not? We don't look at it on the basis of hindsight and say, because things went wrong, therefore it was the wrong decision. And I don't mind telling you that within the 6.5 years or so which I was on the committee, we looked at least about 50 odd cases. And in 25 cases, we said no action is needed. And in all of those cases, it was accepted by the CVC. So long as this system functions, I don't see why there should be a problem.
Okay. Well, lately apparently the problem is resolved after 2011, but there were executive directors of banks saying that up until probably 2010 or 11, the opposition of an ED to a loan was not even recorded in the minutes because the chairman passed the minutes.
I think that's a question which affects all professionals. But with due respect, I don't think that can be an excuse. Whether if you are a professional, whether you are an independent director or you are an executive director, you can't take shelter behind the fact that I said this and it was not recorded. Then you should resign if you think that was not, or you put on record it was not recorded. You can't have it both ways.
Mr. Malegam, you know, lately, 3 years ago, the PJ Nayak committee presented its recommendations and has asked that the government stake in public sector banks be brought down to 49%. And that will make it work like a company under the Companies Act. Will that make a seminal difference? Is that the big mistake we made, not putting public sector banks under Companies Act?
I don't personally believe that will be sufficient. See, for example, in the case of most companies which are run by industrialists, they don't own 51% of the share capital. They may hold 30% of the share capital. So it's not how much share capital you own, but how much control you exercise. In fact, the other recommendation of the committee makes more sense to me, which is that today there is a direct link between the Department of Banking and the bank. Now, if you create in between a holding company, then the ownership of the holding company is with the government, but the board of the holding company is made answerable for the performance of banks. And therefore, to that extent, they can do many things. What I am saying is that there is a difference between a government as a shareholder and the extent to which a shareholder should exercise control. Now, as you know, in good corporate governance, what is the role of the board? The role of the board is to direct and control. It's not to manage. And similarly, the board is answerable to the shareholder. Now, that is the concept which has to be brought into the banks. That the board of the bank is answerable to the government as a shareholder for the performance of the bank. But the government has no right to direct the board in specific matters. And even more so, the board has no right to manage the bank.
Well, we have to take a commercial break, Mr. Malegam. We are back in a minute with more questions for Mr. Malegam.